Alright, welcome to another episode of the Mike Smith Investment Show. My name is Mike Smith. Today we're going to be discussing Schwab US Dividend Equity ETF. We're also going to be comparing it to the Vanguard High Yield Dividend ETF. So to begin, I'm definitely adding the Schwab US Dividend ETF to my portfolio kind of as a less riskier pick. Also allows me to invest in maybe a little bit more of a riskier stock while still being able to have those dividends to come in to kind of limit the risk I take from some of the more riskier picks in my portfolio. Currently, I do have Prudential, NU, AM, Apple, and the Dow Jones ETF. Primarily, it's mainly Apple and NU, but AM has been a very good stock for me. Prudential hasn't been performing the best currently, but definitely NU and Apple are my largest picks in the portfolio, but I'll definitely be adding the Charles Schwab ETF. All right, so let's get right into it. Let's first start with some of the picks or holdings in their portfolio. And they just recently did actually just change this up. Last analysis I had, Pfizer was actually their top pick, along with BlackRock, and I believe Coca-Cola, yes. But all of these are pretty good picks. Their primary sector is finance and health technology. If we look at finance, they've been performing very strongly against the S&P 500 at a 6-month range. If we look at health technology, they haven't been performing the best against the S&P 500, but it's more about diving deeper into these companies and seeing how well they're doing fundamentally, and them being able to pay out a high dividend with good dividend growth and a good dividend yield. So it's important to note that the Charles Schwab ETF is at 27.83. The Vanguard is at 133.35. So for an investor with maybe a little bit less money, the Charles Schwab may be more attractive as it is lower cost. And if I were to compare both of these, if I invested $1,000 into Charles Schwab and Vanguard, Charles Schwab would actually pay out a higher dividend amount compared to Vanguard. So that's another attractive metric, and that's why I'm definitely going to start investing money into this ETF. So let's start off with their top 3 holdings. Like I said, this did change. So we have AbbVie. They pay out a great dividend of $1.64 annually. Oh, excuse me. That's quarterly. Their annual rate per share is $6.29 with a dividend yield of 3.54%. If we look at their statements, primarily their total growth, they have been declining year after year, as well as their net income kind of fluctuating up and down throughout the years. Their cash flow, negative free cash flow, but they're still able to pay out that increasingly high dividend with a very strong, somewhat strong dividend yield of 3.54%. The next company I want to look at is Pfizer, which is at a 4.26% holding. Pfizer is a pretty fundamentally strong company. If you look at their financials and their dividends, they don't pay out as high as the dividend amount. It's around 43 cents quarterly with a $1.69 per share annually and a very good dividend yield of 6.37%. I said this in my past video, which was Paycom. If you haven't seen that video, go check it out. But I like to look at a dividend yield of around 7%. Now, this could fluctuate if the price of the stock increases, the dividend yield then decreases. But if the price decreases, the dividend yield increases. So fluctuates, but it is a somewhat important metric. So theirs is at 6.37%, which is very strong in my eyes. But $1.69 is very good. Fundamentally, very strong company, although they have been declining. But this is a very high turnover ETF, as much as most are. It is stated that it's passive, but it is a very high turnover. I think it's kind of shifted a lot more to a lot higher of a turnover rate in these ETFs and funds throughout the year, because these companies need to, make a profit, attract new investors, and continue to increase their price. So if you stick with the company and it declines, that's not a good look for investors looking to invest in your ETF. But if you're constantly turning over companies with strong earnings and such, this could attract more investors. So a lot higher turnover rate. But their net income has been declining. Free cash flow has also been declining very significantly. If we look at annual, okay, it's increased a little bit. It has increased a little bit, but Pfizer is one that they've held for a while, and a very strong company. Some of the other, like Coca-Cola and BlackRock, these are common dividend companies. Home Depot, Verizon. A lot are held on Charles Schwab ETF as well as Vanguard ETF. So if we look at some of this, they have a dividend yield of 3.56%. Shares outstanding 2.44 billion. Assets under management. So the amount of money they have in their holdings, their companies, their stocks, is at 67.59 billion. So a lot. It's a big ETF. And honestly, I would favor this over Vanguard. Totally forgot this, but the Charles Schwab ETF pays out a dividend of 26 cents, which this dividend has been fluctuating each year. But it all depends, right? If the economy takes a downturn, this won't be this less riskier pick, because now companies are less fundamentally strong. And they may not be able to pay out the dividend. And Charles Schwab may be having a hard time finding really any company that is paying out a strong dividend. So there could be a decrease in dividend depending on what's happening in the economy. Now, Vanguard pays out a higher dividend of 96 cents quarterly. This is increased from September 24 to December 24, 2024. Their highest was $1.10. So a little bit higher than Charles Schwab. Their dividend yield is lower than Charles Schwab at 2.62%. And their assets under management are 61.34 billion. Like I said, the price is significantly higher at $133.33. So much like the Charles Schwab ETF, finance is their top weighted average in their ETF, but they take a different look at electronic technology as compared to healthcare, like Charles Schwab does. But finance has been a very strong sector, and they've been outperforming the S&P 500 by at least 10%, a little bit less. So some of their top picks, we'll take a look at Broadcom. Broadcom pays out a dividend of 59 cents quarterly, and annually $2.10 with a dividend yield of 1.25%. Okay, their statements, revenue, very strong from 2023 to 2024, but actually increase increase, so that's good. The income has also has decreased, so a lot stronger company than the other ones we looked at Charles Schwab, and their free cash flow has increased significantly. A very strong metric for looking at a dividend. Can they pay out that dividend with their extra cash on hand? Now, Vanguard does hold AbbVie and Home Depot, like Charles Schwab does, but JP Morgan is their second top holding. If we look at their dividend, I know they have a strong dividend. Yep, $1.25 quarterly, annually $4.80. Decrease in dividend yield year after year to around 2%. It's due to the significant increase in this stock. This is a very strong company, very strong CEO, and he does a great job at creating this fundamentally strong company. Financials, no doubt, I know, are very good. Very strong total revenue. If we just look at their net income, also very strong, increase after increase. Free cash flow has also seen an increase, fluctuated a little bit with a decrease in 2021, but they've been able to recover. So I mean, overall, they're somewhat similar, a little bit of a different holdings, but I really like Charles Schwab more. I'm not an investor with a huge amount of cash on hand, so I can throw a bunch of money in. But just through my analysis, I like this lower price. Also, like I said, with the comparison of $1,000 invested in both companies, you get a higher dividend amount through Charles Schwab. So why not invest in that company? Definitely will be adding this into my portfolio. We'll be slowly adding money into it each month. More like weekly. Trying to build that up to, I would say, at least $500 to $1,000. But that really depends on what my personal income is at the time. But yeah, I just like this company a lot more. A little bit of a different look with finance and health technology, but their companies are strong. High turnover rate in the ETF, so honestly, they're going to be finding good companies with high dividends. So, like I said, overall, this could limit your risk in your portfolio with that quarterly dividend amount that it's going to pay out. But with the economy possibly in a downturn, I mean, we may even see a war, which could definitely decrease our economy, and tariffs aren't doing the best at decreasing our economy when prices are starting to rise now. This does not mean that it will limit your risk during times of economic downturn, because companies will be struggling and they won't be able to pay out a high dividend. It's really up to you to analyze certain companies and figure out the best portfolio for you. For me, I focus more on a low turnover, focus investment portfolio, only holding a few companies, may be riskier. But if I put in the CTF, it could limit my risk with that quarterly dividend amount. And I also like to hold companies for at least a year. After a year, if they aren't doing well, and I really don't like the fundamentals of the company, I will sell, take it out of my portfolio, and take that loss. It happens. But if the company's doing well, I'll hold it for hopefully at least 5 years. I'm brand new to this. Not brand new, I've been studying it for a while, but really starting to grow my personal portfolio very heavily. And Charles Schwab is a great ETF for anyone looking to kind of just grow their passive income quarterly after quarterly. So like I always say, I am not a professional by no means. So just take this information with a grain of salt. But definitely take a deeper look into both these ETFs and pick one that you like, because they're both strong and they're able to produce, good quarterly income for you. So thank you guys for watching. I hope you liked the video.